Australian investors could soon face one of the biggest changes to investment taxation in decades. If you own shares, ETFs, investment property, or plan to build wealth through investing, this proposed capital gains tax overhaul could significantly impact your future returns. The long-standing 50% capital gains tax discount may be replaced with a completely different system. So what exactly is changing? How will it affect your share portfolio? And could you end up paying more tax when you sell your investments? Let's break it all down. Before we discuss the proposed changes, let's quickly cover how capital gains tax, or CGT, works today. A capital gain occurs when you sell an investment for more than you paid for it. For example, you buy shares worth $10,000. Several years later, those shares are worth $20,000. When you sell them, you've made a capital gain of $10,000. Under Australia's current tax system, investors who hold assets for more than 12 months generally receive a 50% CGT discount. That means only half the gain is added to your taxable income. This discount has been a major benefit for long-term investors since it was introduced back in 1999. Let's see how the current rules work. Suppose you buy shares for $10,000 and later sell them for $20,000. Your capital gain is $10,000. Because you've held the shares for more than 12 months, the 50% discount applies. So only $5,000 is added to your taxable income. If you're on a marginal tax rate of 37%, you're effectively paying tax on just half of the gain. That's why many investors deliberately hold assets longer than 1 year. The proposed reforms would dramatically change this system. Instead of receiving a flat 50% discount after 12 months, investors would potentially move to an inflation-adjusted cost-based model. In simple terms, your original purchase price would increase over time based on inflation. Rather than automatically cutting your gain in half, the tax system would only tax your real gain after inflation is taken into account. Supporters argue this is a fairer approach because it separates genuine investment profits from gains simply caused by inflation. Critics argue that many investors could end up paying more tax than they currently do. Let's use a simple example. You buy shares for $10,000. Over several years, inflation increases the index cost base to $12,000. You then sell the shares for $20,000. Instead of a $10,000 gain, the system would recognize an $8,000 real gain. That's the amount potentially subject to tax. Notice that there is no automatic 50% discount. The benefit depends on how much inflation has occurred during the period you owned the shares. The higher the inflation rate, the larger your indexed cost base becomes. One of the biggest questions investors have is, what happens to shares I already own? Current proposals suggest there would be transitional arrangements. In general terms, gains that accumulated before the new start date could continue receiving the existing treatment. Only future gains occurring after the implementation date may fall under the new index system. This means investors with long-term portfolios may not suddenly lose all previously accumulated tax benefits. However, final legislation will determine exactly how these transition rules operate. So who could feel the biggest impact? Firstly, long-term share investors. Secondly, ETF investors. Thirdly, property investors. The effect will vary depending on how long assets are held and future inflation levels. Investors who rely heavily on the current 50% discount may notice the biggest difference. Meanwhile, investors holding assets through periods of higher inflation may benefit more from indexation. Ultimately, the winners and losers will depend on the final structure of the legislation. The key takeaway is this. Australia's proposed capital gains tax reforms could fundamentally change how investment gains are taxed in the future. The familiar 50% discount may eventually be replaced by an inflation-adjusted system. For investors, understanding these changes early could help shape future investment decisions. Remember, these reforms are still subject to legislation and final details may change before implementation. If you own shares, ETFs, or investment property, it's worth keeping a close eye on developments. What do you think? Would the new system be fairer, or could it discourage investing? Thanks for watching, and I'll see you in the next video.